recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote. You don't need to pay attention to them.
Most investors put an excessive focus on short-term results. According to the New York Stock Exchange, the average time a stock is held in the US has dropped from 8 years in 1950 to under 6 months in 2020. The complication is that it's hard to earn steady money from your investments if you only keep your stocks for a short period of time and keep buying and selling them frequently. As small investors seeking consistent good investment returns by buying wonderful companies for less than they are worth, the key question is how long should we hold stocks in our portfolio? I believe that adopting a long-term investment approach is the easiest way to maximize your investment returns when buying wonderful companies for less than they are worth for the 3 following reasons. Reason number 1, a long-term investment approach provides you a structural advantage over most market participants. Reason number 2, a long-term investment approach enables you to take full advantage of the power of exponential growth that we commonly call compounding. Reason number 3, a long-term investment approach minimizes your risk to suffer a loss. Let's go through each of these points one by one to get them better. To grasp why a long-term investment approach provides you a structural advantage over most of the market participants, it's first key to understand their mindset and the game they play. Imagine you live in a beautiful village with 10 houses including yours. Each of you own your house. Imagine now that after a long period of lockdown because of a pandemic, all your neighbors decide to divorce and sell their house as none of them can individually afford to live in this village. As all houses are put on sale at the same time, it scares external buyers who assume that something weird must be happening in this village. The consequence is that real estate prices in the village collapse. Let's say now that you have some cash and decide to buy 5 houses as you understand that this event created by those divorces is a short-term issue. After 1 year, external buyers realized the issue was short-term and rushed back to buy the houses in large numbers. As a consequence, your investment in these houses benefits because you bought them at the lowest price and can now sell them at the highest price possible thanks to this increased demand. If this sounds like a crazy analogy to you, let me tell you that the stock market offers similar opportunities thanks to the incentive of its participants. Professional investors manage about 80% of the money in the US stock market. These professional investors use other people's money and not their own to invest. They get paid by the management fees that they charge to their clients, which is a percentage of the total amount of money that they manage for them. Those management fees are not tied to their investment performance. Their client must pay regardless of whether the investments made by those professionals make money or not. So these professional investors have a strong incentive to manage a large pool of money to increase their income from these management fees. However, the challenge they face is that they must demonstrate superior investment performance compared to other professionals to justify these fees, otherwise their client may switch to their competitors. As a consequence, professional investors' performance is often evaluated on a short-term basis, sometimes quarterly or even monthly. The rules by which these professional investors play affect their focus on the long term and force them to sell any underperforming stock within their portfolio. Behind each stock, there is a company, as a stock is a tiny piece of a company. If a company owned by these professional investors experiences a short-term issue, they have no other option but to sell their stocks to keep up with their competitors, even if this issue won't impact the company's long-term prospects. As they represent 80% of the market, they will move a large blocks of shares and have a huge influence on the stock market price of the company that they are dumping, regardless of its quality. These strong selling reactions will trigger a strong drop of any stock that they start selling. These strong selling reactions also offer a golden chance for dedicated long-term investors. It creates the opportunity to buy wonderful companies for less than they are worth. To provide you an example, let's look at a company called Chipotle Mexican Grill. It's a popular fast casual restaurant chain mostly based in the US. Chipotle's stock had almost a steady ride from 2006 to 2015 and reached a peak of $720 in August 2015. During that time, some of their customers experienced food poisoning after eating at their restaurants. As you can imagine, many of the professional investors that own that stock dumped it and it reached a low point of $300 in November 2017. Chipotle was still a wonderful company, but they were going through a short-term issue. They fixed the issue and both customers and confidence returned. 6 years later, this stock is now worth almost $2,200, and if you had invested $15,000 in the company in November 2017, this investment would now be worth $110,000 in November 2023. Alongside the chance to buy undervalued stocks, a long-term investment approach also unleashes the incredible power of exponential growth. Let me explain you what this concept is before we dive into our second point. Imagine you have a magic piggy bank. Every day you put some money into it. But here's the exciting part. The piggy bank also gives you coins as a reward for keeping your money inside. So every day you get more money in the piggy bank, and the next day you'll get even more because the piggy bank will give you rewards on the total amount, including the extra coins from the previous day. That's how compounding works. It's like a snowball getting bigger and bigger as it rolls down a hill, making your money grow faster and faster over time. The longer you keep your money in the piggy bank, the more it will grow. This is why Albert Einstein has said that compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it. It also explains that over 90% of Warren Buffett's wealth, which exceeds $100 billion, was made after his 65th birthday. It took him more than 56 years old to get his first billion, and from 56 years old to 93 years old, he grew this first billion to $120 billion. The first key aspect of compounding is the rate at which your money works for you. Warren Buffett refers to wonderful companies as compounding machines because he recognizes that these companies have the ability to generate strong earnings and reinvest back those earnings into the business for further growth. Over time, a company with a strong competitive advantage will grow your money faster compared to a company without any competitive advantage or a company with a weak competitive advantage. Once you have invested in a wonderful company, time plays a key role in maximizing the potential for your investment to compound. Bill Miller, who is a famous value investor, put it well by saying that it's time, not timing, that lead to real wealth accumulation. This means that you need to give enough time to your invested money to compound. The power of compounding is hard to see in the short term, but breathtaking in the long term. If I offer you $1 million today or a penny that doubles every day for 30 days, I bet that most of you will choose the $1 million. Choosing the $1 million would be a huge mistake, as you would lose out on almost $10 million with that decision. In this table, you'll notice that if you choose the penny that doubles every day for 30 days, not much happened during the first 25 days. The amount you make stays below $400,000. However, once you reach that tipping point, the magic of compounding starts to work. After that tipping point, the penny that doubles every day for 30 days becomes 1.3 million on the 27th day and 11 million on the 30th day. Once you have invested in a wonderful company and give proper time for your money to compound, it's also key to avoid withdrawing money from that compounding machine. A long-term investing approach helps you to keep as much as money as possible in this compounding machine, thanks to the cost avoidance you make on your tax payments and transactional costs. Cost avoidance means preventing or avoiding potential expenses or losses by taking proactive measures or making smart choices based on what you know. Except in the case of non-taxable accounts, taxes are the biggest expense an investor faces. Whenever you sell a stock and make a profit, you need to pay taxes on that earned money. An interesting study on this issue has been highlighted in the book called The Warren Buffett Portfolio. The study shows that if you start with $1 that doubles in value every year for 20 years, and you sell the investment at the end of each year, pay taxes and reinvest all, you'll have approximately $25,000 in profit. However, if you hold on to everything without selling, you'll have nearly $700,000 after 20 years. The difference between those two numbers shows how taxes can impact your investment performance over a long period of time. In some countries, tax authorities encourage investors to focus on the long term. In Australia, if you hold onto your stock for 12 months or longer, you receive a 50% discount on the tax you owe on your profits. Your transaction fees can also add up to your tax expenses and reduce the amount of money you can compound over time. If you want to buy stocks, you must use a brokerage company. Those companies help with buying and selling shares, but some of them will impose a fee for each transaction whenever you buy or sell a stock. A long-term investment approach not only helps you to avoid tax and transactional costs, but also another type of cost that is often overlooked by investors. A great company can boost your earnings significantly, but selling its stocks too early can also lead to significant losses. I know that this can sound counterintuitive, but to get this point, we first need to understand the concept of opportunity cost. Imagine that you are planning a weekend getaway and have a limited amount of time and money. You have two exciting options. Option A is going to a beautiful beach resort, and option B is exploring a scenic mountain retreat. Both options sound amazing, but you can only choose one. If you decide to go to the beach, the opportunity cost is the experience you could have had at the mountain. If you decide to go to the mountain, the opportunity cost is the fun and relaxation that you would have had at the beach. Opportunity cost is like a trade-off. It's about understanding that when you choose one thing, you also need to give up on something else that you also wanted. It's the benefit that you are losing out in choosing one option instead of another option. And this matters when you choose to sell stocks from a wonderful company growing steadily at 20% annually or more. If you cannot reinvest the money you got from selling those stocks into a new company growing at least at 20% per year, your missed opportunity is the growth rate difference between the old company you were invested in and the new one. And this gap represents the money you lose as fast-growing companies lead to long-term stock growth appreciation. I call this the lack of measuring stick tax. The key to avoiding it is to stay invested in a wonderful company for a long period of time, as long as you do not have any other better option to make your money work aggressively for you. In addition of minimizing your opportunity cost, a long-term investing approach also helps you to avoid losing money by wrongly predicting the price of a stock. According to Peter Lynch, who was one of the best investors in the world, in the long term, the price of a stock follows the earnings of a company.
People understand there's a 100% correlation with what happens to a company's earnings over several years and what happens to the stock. If the company, McDonald's has done very well as a company,
Right.
the stock has done very well. People worry about too much money supply, what's happened to the price of oil, whether, who's the president, who's being nominated for the Supreme Court,
It's all
the ozone
earnings.
layer. It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
If you buy a wonderful company for less than it's worth with a long runway for growth, your investment should grow over time as long as this company remains wonderful. While a long-term investment approach makes it easy to predict the price of a stock, it can also help you to correct your minor to moderate valuation mistakes. Most of the work done by value investors is to figure out the value of a stock and to buy this stock at a price lower than its value. The bigger the gap between the price of the stock and the price you paid, the better you are protected against losing money with this investment. This is the concept called margin of safety, and the idea is to create a buffer against potential losses if things go wrong. The issue arises after some time when you discover that the value of the stock is actually lower than what you thought, making the price you paid for that stock too expensive. The good thing is that wonderful companies tend to increase in value over time. As a consequence, a long-term investment approach will widen your margin of safety and correct your minor to moderate valuation mistakes. This is it for today, guys. If you had some value from this video, feel free to drop a like. And if you want to receive more content like this, feel free to subscribe. Thank you, guys. Peace out and see you soon.